Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we'll have a look at the latest market moves on Friday and this morning in reaction to the increase in trade disputes between the US and China. We'll also have a look at the likelihood of the Fed cutting. We'll look at European industrial production, some signs of stress in US private credit, and we'll have a look at performance of SA SOEs. We're going to start off with the moves on Friday. It was pretty sizable. The S&P 500 was down 2.7%, and that was in response to a set of factors. As a starting point, the Chinese government indicated that they'd be looking to potentially restrict exports of rare earths. And these are critical components for both the energy transition and chip manufacturing. And the restrictions could be quite onerous. They stated that they wouldn't be allowing exports to the extent that they're used for military purposes. But in addition to that, all companies globally that use Chinese rare earths would require permission to be able to use those rare earths, and that permission may not be granted. Later on over the weekend, the Chinese authorities indicated that should those materials be used for civilian purposes, permission would be granted as a matter of course, but nonetheless, there is still this threat over the global economy. And President Trump responded by indicating that the US would be looking to increase its tariffs on China by 100%. Now, the betting market at this point is pricing in a less than 20% chance that tariff is imposed by November 1st. So at this point, given the walkback that we saw over the weekend, the market is a bit more relaxed than it was before, and we've seen a part reversal in markets across the globe. So a strong decline on Friday, and it looks like based on futures markets, we're likely to see a bit of strength this morning. In the meantime, on Friday, the VIX shot up to 21.7. That's the highest number that we've seen since May. What was interesting about the move wasn't necessarily the market response in equities. That was a pretty traditional response. We see some shock to the global economy, and as a result, equities weaken. And then over the weekend, we saw a bit of walking back of the threats, and as a result, futures are a bit stronger. That's all pretty standard. What was interesting, though, on Friday, the dollar weakened. It weakened in an environment of global risk off. And that's not what it used to do. It used to be the case that the dollar would strengthen in an environment like that. And what's more, so far this morning, the dollar hasn't strengthened. So while it looks like equities would likely open up, it's not looking the same for the US dollar at all. And the reason that's interesting is a lot of people hold dollars because of its safe haven status. And if that safe haven status is coming into question, one could pencil in, we think, even further dollar weakness, even after the dollar has recently weakened. And that's a pretty interesting thought, and we're going to provide regular updates on that going forward. But it does seem to be the case that the dollar is not acting like a safe haven at this point. Switching to the Fed at this moment is flying blind in part because of a lack of data coming out of the US due to the shutdown. The betting market is pricing the shutdown to last another 3 weeks or so. So the Fed's not going to get access to a lot of information in the coming few weeks. They will, however, get the CPI number. And the Bureau of Labor Standards is calling in their people to put out that CPI number by the end of October. They need the number for Social Security increases for next year. And they will come out just in time for the Fed. The Fed meets on the 29th of October, and the market is pricing in a cut with 100% certainty. That's a 25% cut. The market's also pricing in 4 cuts over the coming year, and that does seem somewhat optimistic given the latest numbers we've seen with regards to inflation. So unless inflation starts to show signs of cooling, I think we can say the market is quite optimistically pricing in a set of cuts over the coming year or so, which could be in question, especially if it turns out to be the case that the labour market isn't as weak as is widely expected. Switching to Europe, there's some worrying signs coming out of German industrial production. German industrial production was very weak last month, and the weakest that we've seen in some time. Over the past couple of years, we have seen the German economy underperforming the rest of Europe. So perhaps we shouldn't extend this to a view on the broader European economy. And what we will do is over the coming weeks, as we get more European data, we'll draw more inference around what's happening across Europe. But at this point, it looks like the German economy certainly is in question, and maybe the European economy too. Switching back to the US, but looking at private credit, there are some signs of stress developing. Now, this has been a sector which has been very hot. There's been huge amounts of inflows, but default rates seem to be picking up. The latest example is First Brands, which was announced over the last week or so. And more broadly, we've seen the private credit funds have sold off quite materially and materially underperformed the S&P 500 of late. So it's something we need to keep a close eye on. This shadow banking system in the US, which looks like it's come under stress, and we don't know the full extent of it. So this is something where we will be updating on regularly, but it does look like there is some stress developing in that sector at this point in time. And finally, on South Africa, we're seeing some encouraging signs with regards to SOEs. If you look at the performance in South African ports, measured by the number of containers handled, it's looking pretty elevated, and performance at Eskom has improved too. And the net result of that is that our broad SOE index is starting to show signs of improvement. There is still a concern with the railway network. We're not seeing the same sort of improvement there that we're seeing on the ports and at Eskom at this point. But even so, if we aggregate it all, it looks like our SOE index has ticked up. And if the rail performance simply remains in line with where it is now, we would expect next month our SOE index is going to tick up even further. And SOEs more broadly, up until now, have been quite a strong binding constraint on growth in SA. And it looks like that's starting to ease a little bit, which should allow for faster potential growth in South Africa. And that's likely to be aided by a very fortuitous increase in commodities that South Africa happens to export. If we look at our South African commodity export basket, the 6-month average is up nearly 15% year on year. That happens about once every 5 years or so. It's very helpful for the SA economy, very helpful for the fiscus. It typically leads to an environment of a stronger rand, lower interest rates, and potentially even some tax relief as well. And we're just at the start of that cycle, which suggests that the outlook for SA Inc. is quite positive. And that's where we're going to end it this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.